Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Tuesday edition of Benzinga's PreMarket Prep. Spencer Israel, Joel Elconin, Dennis Dick with you on this Tuesday morning. A couple of earnings trickling in, some ratings to discuss, but not just ratings, also just analyst commentary in general. Stocks move differently to when analysts come out with commentary that aren't explicitly upgrades or downgrades, but are just more broad, bullish or bearish comments. So we'll talk about that. We'll talk about Tesla today. We didn't get to that yesterday. We'll talk about Apple, and we'll take your questions from our chat. Our guest today, Greg Weldon from Weldon Financial. He will join us at 8:35. In the meantime, Joel, what is going on in the overnight session?
Red on the screen again, Spencer, trading down 10.5 handles, 29.68 even. Just opened up and basically went straight down here. Pre-market low, 29.6350. Don't have a whole lot there. What I'm looking at on the downside is last week's low at 29.5550. That's a big target on the downside. Crude just hanging out around $58, up 32 cents at 57.98. Gold loses 1,400, trading down 530 at 1394.70. Silver hanging out right at 15, up a mere penny at 1506. And you got a 12 handle in Bitcoin, trading up $110 at 12,555. Let's bring in Triple D. How you doing this morning?
Head on a swivel. A lot of news. Merger breaking right now. Cisco, CSCO, just broke at 8 o'clock to buy ACIA for $70 a share. ACIA trading up right near the price 6801. I'm not sure if it's in cash. I just saw the headline go by. Cash. I shorted Cisco on it originally, but I've already covered because it's such a small deal. I mean, you're seeing Cisco get hit on this down to the tune of 2%, but this is like a $3 billion deal for a $240 billion company. I mean, it's getting ridiculous when they want to knock 2% off the price because it's doing a $3 billion deal. Anyways, it's a small deal for Cisco. I'm shocked that, they're hitting it down this far. That's just algos. Oh, they're inquiring. They got to hit it way down. I don't think it's, when it's flat, it's one thing, but come on, you're going to hit this thing down $1. That's another thing.
All right. So you're in and you're out.
I'm in and I'm out. Yeah.
Okay. All right. Cisco just spiked down to 54.92.
Yeah, they hit it down $1.20 because and it was trading around 55.90 when this happened. I got a little bit in the 55.60, 70 area. I missed though the bulk of it, so I just had a little piece, and I covered immediately in the 55.
Quickly? Just right away.
Right away. I was in the trade for less than a minute.
Okay, that's probably not a bad timing be for first in, first out on that one.
Yeah, I wanted to be first out on that one. Anyways, it just goes to show you the algos hit Cisco all the way down there. It's ridiculous, and it's coming all the way back here now. As they start saying, like, you got to analyze it from a market cap perspective. It's one thing when it's a huge deal like Allergan and AbbVie, okay, and they're going to hit it down, but if you're paying like an extra $1 billion or something, you're knock $5 billion off the market cap. Does that make any sense at all? So in the Cisco case, I was just, if we just quickly do the math on it, look, Cisco, when you're trading down, how many shares are outstanding? I'm just grabbing it here right now. So there's 4.2 billion shares outstanding. So literally, they pay an extra $1 billion for the stock ACIA, but they knock $5 billion off the market cap. The algos there, $5 billion. Come on. The math, algos, rewrite yourself. You can't just hit any random bid because it's acquiring a company. So anyways, you're seeing it come all the way back. People who are selling at 55 just didn't do the math.
And how do you do that in the math in your head? I mean,
I just looked. The first thing I did was look up what is, I hit it too. And it's like the headline you hit it. And then I was like, wait a second, this is a small deal. And then I looked the market cap of ACIA and it's like 1.6 billion. I'm like, okay, cover. because this. So I was liking algo on that. I hit it too. But 1.95 billion was the market cap as of yesterday. So it's going to be, they pay an extra $1 billion for it. So maybe they knock $1 billion off the market cap. Maybe if they really hate it, they knock $1.5 billion. But to knock $5 billion off the market cap for a $3 billion deal is absolutely ridiculous, in my opinion.
And well, we'll just keep it. I'll just give you one number in Cisco today, since you did get hit. Let's see what happens if it gets to unchanged here at 56.19 on the session. That's my level for that. ACIA, well, first of all, no one got the memo, as this thing came off hard off $64 in the last couple sessions, all the way into the 40 handle. I don't know if that, or 54 into the lower or upper 49 handle, way off its all-time high of 128.73. So I'm not sure what the expectation.
This cash deal, is it all cash, Spencer?
Yes.
You can read the headline. I didn't have to read the whole thing.
All cash.
All cash. Okay, so $70. So 3-point discount here for time value of money and risk the deal doesn't go through. All right, so that was happening right on the fly here at 8 o'clock.
Any sympathy plays with ACIA?
Small deal, Joel. It's hard to really jump in, and I don't even know much about it at all. If anybody does know that off the top of their head, it's a company that I don't follow closely. I'm a mega cap trader, so these smaller companies.
Maybe like a Juniper is small.
Juniper, Cisco, but ACIA,
Sienna. Well, they're all.
I don't know.
They're all peers.
Question for somebody else. I have no idea. I don't follow ACIA at all.
Cisco's a peer, and that's the point. So. All right, yeah, maybe there are, but they're smaller names.
I'm sure, yeah. It's a small name. It's hard to, go on the bigger deals. The sympathy plays come more into play than something that's small. This is a small company.
Small deal. Okay.
Very small. So if somebody's got a peer, let me know. We can mention it, but I have no idea.
Where did you guys want to go? We can go to the earnings or the one or so.
Let's just talk about this overnight weakness again, Dennis, for the second day in a row here.
They roll.
Yeah. To a little bit of follow through.
Yep.
Actually, Friday was weak. After the jobs number. Today's week, I guess the slam dunk on interest rates going down 1/4 or 1/2 is not such a slam dunk. I guess you have a little trepidation with Jerome Powell speaking today and tomorrow. So a little bit of a pullback, but the majority of the pullback's been in the overnight sessions.
Just going back, our chat is awesome. And if you're not in the Benzinga chat, you should be. PreMarket.benzinga.com. The chat there. Griffin is saying AAOI. Spinner is also saying AAOI. This is sympathy plays for the ACIA. IIVI and NPTN. So I don't follow any of those companies. Like I said, I'm a mega cap trader, so I don't follow any of those companies closely. But they are saying that those are potential peer plays here. If you do look at the AC or the AAOI, it is trading up 8% right now. Started popping right on that deal news, so it does appear that they're correct with that. IIVI is up a buck. NPTN also trading 5% higher. So good job, chat. You're all over it.
All right. And Dennis, any comments? The weakness in the market here since that?
I mean, it's 2 days, right? So I often think, when you get a little bit of a red can, a little bit of nervousness, you often have follow through the next day. It's what we're seeing. Let's see how we do at 10 o'clock. Do we start to come in and buy the dip, which we seem to do on day 2, or do they turn around and just keep selling them? It's a big, important day for the market. But, one driver for the market on the upside could be Apple. Apple had a terrible day yesterday, was probably a source of the weakness with the Rosenblatt downgrade. You have positive commentary coming from 2 major analysts here. The JP Morgan note last night was talking about channel checks. I know Rosenblatt had talked about channel checks. Well, JP Morgan saying the channel checks are good. So this is why Apple is trading higher here this morning, guys. I'm long Apple on my long-term portfolio. I'm also long it for a trade because I think it could get some of those losses back from last night from the Rosenblatt downgrade, because in my opinion, I was looking through this JP Morgan note, and this is basically says it's kind of the opposite, some of it.
And Evercore basically saying the same thing this morning. Both,
Evercore is positive too?
Yeah, both saying that that iPhone sales are going to be incrementally stronger.
Their channel checks are good. Yep. So they're saying they're disagreeing with Rosenblatt here. So, I mean, this lost $4 yesterday on that Rosenblatt note. And now you've got a couple major analysts coming out and basically disagreeing. So I don't know if it gets all the way back, because obviously when things fall, they don't come back right away. But I'm not surprised it's trading higher here today. And if the market was flat or higher, I think Apple would be up a lot more. So do you have any highlights from that JP Morgan note, Spencer? Kind of throwing you under the bus for that.
I mean, that is the highlight. So let's see here. iPhone shipments in 2020 are going to be incrementally stronger. They're forecasting 195 million iPhones being shipped next year versus 185 estimate that was previously given.
Yeah.
Mostly just that. That's the bulk of it. And Evercore, from what I saw, was the same thing.
Okay, and there was Morgan Stanley had a note out there too. They were talking not really on that side. They were looking at the App Store stuff. So I didn't read the Morgan Stanley note, but there's a Morgan Stanley note out there as well. So multiple analysts commenting on Apple today, mostly a little more bullish than bearish. JP Morgan did raise their price target, no upgrade though.
Right, and Evercore, they were highlighting Apple services revenue in June in the second quarter.
Yeah, interesting. So you got a little analyst fight here going on. We'll see who ends up winning here. Like I said, I am long some Apple just because I think they could get some of it back. I've got long-term portfolio I won't touch. Short-term, I will be trading out of this probably after the open. We'll see what it does.
It is funny. One analyst downgrades Apple, and the next day, 3 analysts come to its defense.
They basically did. That's basically what's happened. 3 analysts have come to the defense of it. So it's interesting. It's interesting. I mean, this is a weak tape. So it's showing you Apple's got some life here, because Apple's obviously a major component in everything. I mean, the Qs, it's the biggest component of the Qs. Qs are down 0.5%. Apple's trading up 0.1. This is because of the note. So if you're looking for the reason, that is the reason.
You watch a follow through 20052. That just stands as your pre-market high as we speak. If you're looking at the dailies and you want to get some of those losses back, Friday's close was 0423. I don't think they're quite going to make it back that area. But if you're looking for a gap fill, the 2 lows from Thursday and Friday, 0269 and 0290. 0290 would fill the gap. So that's a couple bucks away from here. So I don't know, Dennis. I mean, unless the spoofs turn around and rip, I don't think it
market's weighing on it. Let's see what the market does. I think if the spoofs turn around and rip, it's going to be because of Apple. So if Apple rolls over this market, Apple's going to be your leader today, in my opinion. Apple is the reason why the S&Ps have kind of come off the overnight lows here too. It started going up and the market started helping a little bit. I think if Apple started to go green off these notes, like significantly green, I think it would help the market overall. So keep an eye on Apple, even if you're trading just the S&Ps, because Apple could be one of your leaders here today.
And no love for the Deutsche Bank plan here.
We didn't give it any love yesterday. I continue to give it hate. I've given Deutsche Bank hate a lot. I'm short the 2 preferreds, both of them, DXB and DKT. It actually worked out well yesterday. I was actually able to get DXB in the pre-market there above $25 short. It's 24.76. Like, these things don't move a lot, so don't expect huge moves. But all I'm saying is they've cut the dividend to 0. These are actually capital trusts, so they trade a little bit differently than a preferred. They're more like a bond, like a traded bond. But you can see the move yesterday. I think there could be some little follow-through weakness in these. These are more short-term trades. But I just think with DB going down and they're not applauding that, maybe they start hitting the DXB and the DKT a little bit too, which they started doing yesterday.
Yeah, and our bank's just kind of holding steady on that, but nice that DKT got hit quite a bit yesterday.
Yeah.
And see if he gets a new low for the move on that one. So good, going to the preferred markets, and I know that's been a preferred strategy.
I used to trade the preferred stocks back in 2007, 2008 in the financial crisis. I traded the preferreds a lot. And they were fun to trade because he had credit risk going on. So things were going all over the place. I mean, and we talk about that too, Joel. And I actually bought some of my long-term portfolio, and those things were huge back in 2008, 2009. I've talked about those strategies a little bit before. But, when you have a financial crisis, and credit concerns all of a sudden, and a lot of banks, you get Barclays, and you get Lehman Brothers going under, and Barclays having to get bailed out. I mean, there was opportunities there anticipating that, hey, maybe this is starting to get ugly. I can remember I had the Barclays preferred, and it was still trading at par in like mid 2007. Barclays, the stock had went from like 80 down to 40. And I remember saying to my wife that, hey, I don't know if it's, plausible that Barclays, you know, that when we're talking about, you know, going under, or not Barclays. I don't know why I'm saying about
Bear Stearns.
Bear Stearns. I don't know why I'm saying Barclays. Sorry, Barclays. Not talking about you. Bear Stearns. So it's tiredness is what that is. I was talking Bear Stearns. So I was like, I don't know if it's, you know, plausible that Bear Stearns is going to go under, but I think it's possible. And I can short the preferred stock in Bear Stearns at par right now. And the only thing I'm basically paying is the 6% dividend. I was like, I'll take my shot. I'll take a chance on that. And in 3 weeks later, that preferred stock had fallen by 50%. So, I mean, that was, you know, I made a lot of money shorting those preferreds. Lehman Brothers, same thing. There was just an opportunity. They really lagged. Is Deutsche Bank doing that here? I've tried to play this a couple times in the past and it really hasn't materialized. So we've seen Deutsche Bank get hit, the preferreds get hit a little bit, and then they bounce back. So I don't think, you know, it's going to be a play that this DKT, DXB are going to fall by 20, 30, or 50%. I think they could fall by a few percent, though. So I think it's a short-term trade. I mean, if DB continues to go down and continues to get ugly, then it's a different story. But it's a cheaper way. It's a safer way, maybe, to, you know, play, you know, if you're thinking, you know, DB has some serious problems. The downside is the borrowing costs on these things, which didn't exist really in 2007, 2008. Locates weren't nearly as expensive back then. So you got to look at your borrowing cost to borrow those securities, how easy they are to borrow, and then you got to pay the dividend as well. So there is some considerations there. I wouldn't want to be holding these things for like years. It's just, you know, short term, there's some weakness in DB right now. So I'm playing that through the DKT and the DXB.
And Abner's boy, I mean, you did a pretty good explanation there of what a preferred stock is. I mean, it does have preferential treatment to the equity holders, and it's more like a bond. I mean, I don't know how much more we could get into.
It's kind of a hybrid. I mean, you know, and you can just Google preferred stock. It's kind of a hybrid between a stock and a bond. They trade more like bonds. You know, you're not participating really in the upside. You're really just in it for the dividend. So the one consideration is with typical preferreds is they can't cut the dividends and the preferreds until they cut the dividend in the common. Deutsche Bank did cut the dividend in the common yesterday, but these are capital trusts, so there are a little bit different rules in there. So I don't think they can't cut them as easily as if these were straight up preferred stocks. So it's different. Spinner's asking me, did I ever buy convertible preferreds and short the commons? Oh yeah, I've traded the preferreds on all different ways. So, you know, and that's different strategies too. When you've got the, you know, they come out there and they issue new things, and you can buy the convertibles and short. I mean, there's all kinds of exotic ways to play these different things. I have not traded preferreds very much, really. I trade them every once in a while, but I haven't traded them much in the last 7 or 8 years. Probably because they don't move around a lot anymore. We're not in a financial crisis. We're not in credit risk. If we go into a financial crisis, I'll be getting down and dirty in the preferred stocks again. But we are not even close to that at this point.
Did you do that with HSBC? Didn't you buy?
Well, I was doing different with the HSBC back in 2007, so I had some different plays. The HSBC preferred was just getting annihilated, and it was down 80%, and it was trading with a yield of 30%. And then it was trading, and it got even sillier. So it was 25 par, and it traded down into the $3 handle, which gave it an annual yield of 45%. So HSBC, the stock, this was when everybody thought every bank was going under. HSBC, the stock, it went from like 85 down to like 35. So I'm like, you know what? I'm going to buy the preferred and short the common against it. And if it goes to zero, then I'll still be at scratch because everything will be worthless. So, but if it comes back and doesn't go to zero, I'm going to get paid 46% of my money. And, you know, I don't think the common, even if the common doubled from here, well, I think the preferred's going to triple or quadruple from here. So I did that, and I put it in the long-term account. And that was one of my best long-term trades of all time, because the HSBC ended up going down to like $18. So I would have been down like 50% on that. But, you know, that preferred stock, you know, obviously, you know, that I'm long, held on, and then it started just to rally, and it was the leader of the rally, and it went from 3 to 6 to 10, and, you know, it doubled. So I was able actually to, and HSBC had started coming back too. So I was able to just lose slightly on my HSBC short, but I tripled my money on the HSBC commons. So that was just really good. And then for fun, I held some, because I was like, I think we're coming out of this. So I was actually out of my complete short, and I held on to a bunch of that HSBC preferred stock. And 5 years later, I held on to it in a long-term account. 5 years later, they got called in at par, and I got $25 for all those, and I was buying them at 3. Plus, I got paid those 45% dividend, you know, on my initial investment the whole time. So, you know, and you have a similar story on your Morgan Stanley preferred. You bought those in the financial crisis, and you made a killing on those too.
Yeah, long term, and they eventually call them in. I believe I did Goldman Sachs and Morgan Stanley. The thing with Morgan Stanley, though, I didn't do anything with the stock. I just did the preferreds.
Yeah.
I think it was like 25, 30%. The stock was like at 18, 19. But I tell you, when it went down to $6, I was just kind of like, okay. Yeah, like, but eventually, and then I just hope, I just dreaded the day they called them in, and they did, but those are rare opportunities in the market.
Because these things are callable, and as interest rates came down, you've got preferreds that are yielding 7%. They're going to call those in and reissue ones at 5. So they're typically issued with a call option to the company after 5 years. So when you're buying like a new preferred issue and it's got like a 5.5% dividend or 6% dividend that it's paying, typically those are issued with 5 years to go. So in 5 years, if interest rates have dropped substantially, they'll call those in and reissue new ones at lower rates. And that's what we've seen happen with all the preferreds. I mean, all the 7 ones are pretty much off the board. The only one I talk about is the DDT one, which I've never call in, and I don't know why. And I was in this for a long time, and I obviously should have kept holding on to it because it's still yielding 7% here at the price of $26.35. But it's callable at 25. Like tomorrow they could call in. I don't know why Dillard's doesn't do that and reissue lower. Maybe they think they can't issue low, or they can't, I don't know, get people to buy it. But I'd be surprised that was the case. So I don't totally understand why DDT doesn't call in that one in.
Okay, so let's take, we had one earnings stock here, right? Pepsi-Cola. Do we have the results for PEP?
We do. This is about 6 a.m. this morning. Q2 EPS $1.54 versus $1.50 estimate. Sales $16.45 or $16.42 billion. So a beat and a beat. They see their fiscal year organic sales growth at 4%.
It's a nice pop. What do you expect? I mean, the stock's been running. It hasn't run like some of the Procter & Gamble's though, so we got to put that in perspective. I know Kramer's saying it's running. It really hasn't. It's kind of been hanging on. I don't know. It's up here. It's a verbal tick when you say I don't know, but 134 is where you got some size offered here, at least in our ARCA here on the pre-market. I'd say that 135 number is big. How high did we get in the pre-market?
Getting a little bit of price action here above haven't got above 135. 134.80 has been your high. So they're protecting that size in the book at 135 perhaps. Your first spike was up to 134.71. So it's challenged that area twice and quickly retreated. If you're hanging out for the all-time high, 135.24. That was the all-time high on June 24th. Our all-time closing high, maybe someone's trying to wiggle out there, all-time closing high at 133.99.
I don't think you're going to see a big move in either direction on this. This is a smaller stock. The report's like a little bit better, so it's kind of just hanging out. 135 resistance, maybe it takes it out, man. And if it started to sell off, you get all kinds of buyers in the lower 130s. So I don't expect a big move here.
All right, I think
LEVI we're going to get tonight, I believe. Levi Strauss.
Yep, and WD-40 for a couple big ones.
Yeah, so LEVI, just preview, just give us a technical on that one because we are going to get that earnings report here tonight. It's been running. Been running for 4 days, 21. So this is your classic run up into the earnings report.
Sure.
And typically that means that they've got to do a little bit better than they would if in the case where it was running down into the earnings report. So I would say that if this does beat, you got a lot of overhead resistance around all those 24s, and you've run up into the report. So I'd be nervous holding into it just because expectations are going to be a little bit higher.
Yeah, nice winning streak. Spencer, you got any preview on those numbers there? Or,
For Levi, well, it is their first report since the IPO.
Is it?
Is it not? Oh, let me see here. It is. I stand corrected. It is. It is not. It is their second. The estimate for tonight is EPS of 13 cents on revenue of $1.3 billion.
All right, we'll see if you get any profit taking ahead of the report. Close strong yesterday in a week tape, 23.37 close, or 23.37 high, 19 close. Let's see, you got another high there. Maybe if you want to lighten up ahead of the report, I do see a high just under $24 at $23.91. That's 70 cents away. And the all-time high for this issue is $24.50. So Nice rebound here for Levi going into the report. And I don't know, just one thing you want to keep in mind what Dennis said too. This stock was at 2045 just on June 26th. And you've rallied a cool $3 from that area. So a little pre-earnings run up in Levi. Let's see if they can blow it away and continue higher.
All right. Before we forget, I want to talk about Tesla here because we had I mentioned it yesterday, and then we kind of forgot. Dennis has an idea.
Well, I mean, I've talked about this idea before, so it's not like a huge idea. It's something I was thinking about doing yesterday, but I have not done here yet. I just think, and I was talking to a couple people, and I'm not going to drop names or anything, but I was talking to one of my friends who's an engineer at Toyota a couple months ago, and then I was also talking to another friend who's works for a major parts supplier, and both of them were saying how much that they believe in the Tesla story. My friend from this Toyota, the engineer at Toyota, was saying they are so far ahead on electric vehicles. He's like, if that stock was to fall down, he's like, somebody buys them. And my other friend, the parts supplier, thought the same thing. And I've been saying this too. I do not think that this stock goes to zero. Even if they keep burning cash, I don't think it goes to zero, because I think if it gets low enough, I think it gets down to, like, let's just say in a worst case scenario, it goes down to like $100. I think somebody buys them there. I think somebody comes in. I think you get one of the major auto suppliers that comes in and just says, okay, I'm buying it. And Musk, yes, maybe he doesn't want to sell, but at a certain point in time, board will pressures, if the stock was really getting ugly and stuff, would push for a sale, and maybe to survive, he would do that. So that's the worst case scenario for Tesla, in my opinion, is that the stock, they keep burning cash, they can't figure it out on their own, and somebody buys them. The best case scenario is Musk figures it out, stops burning cash, starts making money, and the stocks go higher. So in my opinion, just my opinion, this is all my opinion, I don't think the stock, I don't think it goes to zero. So how do you, make that call? I'm not sure, if Musk figures it out. I'm not sure if it collapses to $100, but you can go look at the options market. And I was looking at the premiums you can get, and they are crazy. I know Jeremy Newsom was writing some long-term puts on this too. It'd be interesting. Next Tuesday, we'll have Nick on again. We'll get his thoughts on it as well. But if you go out to like the June 2021 and you go look at the premium you can get for the 100 puts, it's pretty crazy. I mean, 100 puts, you can get $17 for that. $17 for 100 puts. So I mean, you're obviously your risk. Your cost base on that would be 83. So your risk would be $83. So if it does go to zero and I'm wrong and nobody comes in to buy them, then you're going to lose. If it goes all the way down there by 2021, which is almost 2 years from now, you'd end up losing your $83. I mean, if you wanted to keep, buy what Nick often does is, buy sacrifice puts, you could turn around and buy like the 50s for like $6. So then you're only making 10 points. So you're risking yourself not quite as much. So that's a different way to play it. I mean, if you want to get aggressive and say, look, I think somebody would buy them at 100, why not rate the 135? You can get $29 for the 135 put 2 years out. That's big money. So then you're averaged in around $100. So I'm thinking, I might play that where I come and, write the 135 and then that's just making the call and saying, hey, if this stock gets under $100, somebody's going to scoop them up. That's my opinion. And I do not, we've had multiple people come on our show and say this is a zero. I've seen multiple people on CNBC say it as well. I disagree with that. I don't think it's a zero. I think somebody would come in and buy them up. Yes, there's some debt to swallow, but at that point in time, there's not as much equity value to swallow either if it's really getting ugly. So that's my thought process. I think, I might do some of that where I'm writing the lower puts just in the event that I think that they don't go to zero. Joel, what are your thoughts?
I'd do a spread,
to play it safe.
Yeah.
Maybe that's a smarter way to do it.
Yeah. And you tie. And the other thing too, if it just goes nowhere, which the stock has done for how many?
You collect that money.
Collect the money, and that's the thing that that Nick's talked about and other options traders is not being 100% right and not be 100% wrong. You just let the the premium just decay, and it's a great strategy. Obviously, it worked in this.
It's worked for Nick for a lot of years.
Yeah. Yep.
I don't usually write puts, but I'm pretty confident. Like this has been my thought process too. I mean, I've said this on the show, that I think if it goes low enough, somebody would buy them. I think Jeremy Newsom, we were talking with him when he was on the show, and he agreed. I've talked to two. I think I think. And obviously I could be wrong, but I think somebody would scoop them up if this stock price really started to get ugly, if they had major problems where, okay, we're going under. I think the technology is so good that one of the big auto companies would come in and say, okay, well, we're coming and buy you. So I don't think it goes to zero.
I just saw that Red Hat was halted a few minutes ago. I think the IBM acquisition has closed. So
is it closed now? I knew it was going to close. So what was the price on it? 190?
$34 billion was the total. If you want the price.
Whatever it was, yeah, it was cash though, so I can't remember.
Yeah,
it's coming closer and closer and closer to it. So that, we know this is going to close.
Red Hat off the board.
Okay.
Okay. 8:31 here. Got about 4 minutes before we're going to grab today's guest. Any notable imbalances?
Oracle again, 59,000 to sell. It's interesting. General Electric, 455,000 to sell in GE. So every single day, it's like Groundhog Day around here. You see GE with a big sell imbalance. Bank of America, 84,000 to sell. Pfizer, 57,000 to sell.
Look at that.
I'm reaching here. DuPont has 29,000 to sell, but we're down significantly. So you knew you're going to have a few sell imbalances. Only big one really is GE, which has a big one every day.
Yeah, it did. It stuck over 1050 last week. Put a pair of highs in at 1072 and did its usual peel back off the level. 1014 was the low from yesterday. So that's been in a 10 to 1050 trading range here for quite some time. We also should mention Verizon and AT&T.
Both ex-dividend.
Yeah. And we talked about that yesterday. Verizon traded down 69 cents and AT&T down 55 cents.
Yeah, and you have to adjust. So the adjusted price on AT&T is $33.74. It's down 2 cents. And Verizon, the adjusted price is $57.28.75. It's a quarter-cent dividend on top of that. So $57.29, say. It's been $57.20, so it's trading down 8 cents. So they're holding up fairly well.
Yeah, so if
that being said, typically this is the day you usually see weakness. They've run up, AT&T at least. Verizon didn't really run up that much. We had the downgrade that didn't help it either though. But AT&T has run up. So I would not be surprised if AT&T shows some relative weakness here after the open. We've seen this happen before. So caution to the AT&T buyer.
Yeah, for the big, that had a big old run up. So
big run up.
Keep an eye on that adjusted price at 33.74. Needs to get over that off the hop. We still got a little over a minute here. Looking at the S&Ps, trying to get off the mat here. Down 9.25 still. Not too far from mid-range on the session. 71.50. I think a good area on the upside to keep an eye on here is going to, let's just call it 73 even. You had Wednesday's low in that area, Monday's low in that area, and then Friday's low just below that. So a trio of lows in the same area now will act as potential resistance here on the run up, on the potential rally.
All right, it is 8:34. Let's go a minute early to today's guest. I'm going to bring him on here. Greg Weldon from Weldon Financial. He's been on with us in the background. I'm going to bring him on now. Greg, make sure he's here. Can you hear me okay?
Yeah. Hey, can you hear me?
Yeah. How's it going this morning?
Good. How are you guys doing?
Doing well. What is on your radar this morning, Greg? We actually have not mentioned Jerome Powell yet. He's entering the gauntlet here today. We've got his speech up in Boston today, his speech in front of Congress tomorrow, and the next day. So he's got 3 key speeches. We have not mentioned that at all. Are you going to be watching that?
Oh, absolutely. I mean, the gauntlet has been thrown. I mean, you talk about the gauntlet's been thrown by Donald Trump here. And, you know, sometimes it would be best served to kind of get what he wants if you keep his mouth shut. Pressuring the Fed, not necessarily the right way to go to get what you want out of the Fed. But that is really a side story to the bigger picture story, which is more simply this kind of polarization of expectations versus what could really happen versus what the Fed is telling us they perceive doing going forward. You know, we talked about this maybe 2 or 3 appearances ago on your show as to how this would have to be a process to get the Fed to the point where they might actually, you know, be in a position to cut interest rates, number one, and number two, where that might be warranted by the backdrop of the, you know, economic situation. And the last time we spoke, it was more around, you know, the economic situation doesn't necessarily, you know, demand it or mandate a rate cut here as much as the, kind of the intra-market and the intermarket global situation would mandate it, because other central banks are frozen here. The ECB in particular, the Bank of Japan for sure, the Swiss National Bank, the Riksbank in Sweden, and even to a lesser degree, the RBA in Australia and the BOC in Canada. So that kind of puts the Fed in play without the U.S. economy being, to the nth degree of a rollover like we see in Europe, which is really serious. And you juxtapose that against what the Fed funds futures and the U.S. Treasury market is pricing, the gap is enormous. And this has to reconcile. And to me, that puts the stock market kind of, in a landmine, in a field of landmines. So when you look at the Fed funds strip, there was actually a point at the most recent low levels of yield here in the U.S. where the September Fed funds contract was pricing in 50 basis points worth of rate cut. And without an August meeting, and with the July Fed funds futures priced right where the Fed funds is right now, which is actually at 242, the effective Fed funds rate as of yesterday, that would imply one of two things. The market was suggesting, we believe one of two things is going to happen. Either they will cut between meetings in August when they're on vacation, or they're going to cut by 50 basis points in September. And frankly, guys, neither of those things was going to happen. So you've had some mispricing and expectations that have gone just too far to the degree of easing. Now, I mean, man, there's so many tangent things to talk about off of that. The stock market has rallied based on what the fixed income market is pricing. So that may be problematic for the stock market going forward. On the other hand, the dollar has not. And that is a tell potentially of issues globally that is keeping the dollar boosted, when normally this kind of pricing in fixed income would have caused the dollar to break down. You would have seen the dollar take out 95.02. You've seen kind of gold pricing that in a little bit too, although gold is its own animal right now and almost doesn't even care, nor should it, about kind of what's going on with this little dynamic. But my bigger picture point here is, Fed's on the hot seat here. Powell is a different animal than Yellen or Bernanke. Yellen and Bernanke were students of the 20s. They were, we have to fight deflation. They had to fight deflation. They knew how to fight deflation because that's what they studied. Powell told us last August in Jackson Hole, I am a student of the 70s. I do not want to see a repeat of the Carter era, of the late 70s when inflation was out of control to the point where Paul Volcker had to come in and raise interest rates to like 16%. So this is a different guy. And, putting that in the box with Donald Trump and what he wants, and man, you got a real mess here. And how this is going to be reconciled, to me, is going to be fascinating going forward, because something's got to give. And right now, I'm really not sure what that something is going to have to be.
I mean, you can't ignore what's going on with Deutsche Bank too. I mean, massive restructuring, cutting a bunch of jobs. I mean, is that, U.S. exposures to those, to the Deutsche Bank is another big unknown in the market.
Well, Europe in general is a huge unknown right now. If you look at the most recent economic data, I did a piece on this at the end of June, June 28th, and then again, another one yesterday. If you look at the economic data in Europe, I mean, in the last year and a half, you've gone from very strong real GDP growth, even though inflation was at or above target 2% ECB target in many European nations, Germany in particular, to where now real GDP has been negative and falling, and nominal GDP is now, flirting with zero or lower levels. The PMIs, the EU Commission surveys, all of these kind of forward-looking, macro indicators imply something along the lines of a 2 or 3% negative GDP in Germany. Now, how is the ECB going to deal with that? The ECB has, Mario Draghi's kind of come out and said, look, we could use all tools available to us and we could cut rates again. Well, the Euribor futures market, the 3-month deposit rate in Europe, has priced that in to the point where they're pricing in 20 basis points of rate cuts by the end of the year. And that would take the official overnight deposit rate in Europe to minus 60 basis points. There are limits to what they can do here. QE in Europe's not going to matter anymore. So this really puts Europe in the center of all of this, in my opinion, because the economic need is there. The inability or potential paralysis of the central bank is a major problem. So the end game kind of becomes, can Super Mario pull another rabbit out of the hat? Frankly, in this case, it's pulling something else out of somewhere else, if you ask me. But there is a thought process here. And from what I understand, kind of behind the scenes, part of the discussion is really radical here. All right. What if, let's just say, what if the ECB were to actually raise the deposit rate? And what if they were to raise the deposit rate to, let's say, 2%? All right. Well, that would be a pretty dramatic move. And, your initial thought process might be, wow, that's going to be really damaging. And why the hell would they even do that? All right. Well, the thought process, number one, is we're hurting savers. I mean, if you have to pay the government to hold your money, that's basically sucking money out of the economy. They can't allow that to continue to happen. It's a real negative. So if they were to raise the deposit rate, where you actually get paid 2% to put your money in the bank, that would potentially, cause deposits to increase. It would pay out savers. It might create some margins for the banks. If at the same time they established a two-tier system where they had a borrowing rate, all right, linked to the LTRO, which is basically where they, the European version of QE, where they print money and put it into the banking system. A little more complicated than that, but that's essentially what happens, where they create a borrowing rate for the banks using the LTRO program of, say, minus 2%. Okay. And in that way, and this is what they're talking about. Okay. They are discussing this, very earnestly behind the scenes. If they implemented this, they'd be paying consumers. Savers would start to have some income again. That would solve kind of that issue, would also provide the money, deposits growth for the banks. At the same time, the ECB then can facilitate the commercial banks in Europe to borrow from the ECB at minus 2% and lend to consumers and businesses at minus 50 basis points. Think about the impact of that. I mean, holy mackerel, this is QE on steroids. This is a whole new ball game if they pull this off. And frankly, I mean, this is what they're talking about. And in that case, you're talking about the central bank basically paying the banks to pay consumers and businesses to borrow more money. And that is like monetary Armageddon. And this could be huge. And the implications for the markets would be rather dramatic.
So
and
where's there to hide, Greg? Where's there to hide?
What's that?
Where's there to hide? Like what?
Well, I mean, the place you'd want to be looking, but look at the breakouts you have going on in some of the European stock markets. The DAX, the German DAX, is breaking out. The CAC 40 in France is at like a multi-year high here. Breaking out of a 5 times top over the last 2 years. Even Italy, we've been long the Italian bond market. This has been our big trade. And it is killing it, man, because you had a 3% 10-year there, and this was the only place where there was any VIG. The Italian economy needs it. They tried to implement fiscal easing, and the EU stepped on their throats. So this is a whole game changer. And where you would want to be positioned theoretically would be to kind of be short some of the fixed income products in Europe, particularly at the short end, because interest rates would be rising, and to potentially, at least for some time period, to be long the stock markets there. And at the same time, no doubt, and I think this is a whole nother discussion, but no doubt that would be one of the most bullish things that I've seen for gold in 35 years of doing this.
So you're liking this pullback in gold here back under 1,400. We got up to 1,440 here. So you're liking it. You're liking this pullback here. Any areas of support where you'd like to add to your gold position?
Yeah, absolutely. We were long gold from below 1,200, actually 1,196. We got out here at 1,402, and we are looking for a pullback to get back in. It's pretty clear where the support is in dollar terms, and that would be down where you broke out, which would be anywhere between 1345 and 1370. I think if you get a 1360 to 65 range, that is great value in terms of gold. That's not to say there isn't risk to gold here, because if the Fed doesn't kind of play ball, okay, in that case, the dollar could break out, and that would be really negative. And the other thing I would mention in terms of the Fed is you've had 4 or 5 of the regional presidents in the last 60 days in speeches use the same terminology, that they're concerned about the credibility of their inflation target. If that is true, and there's no reason to think it isn't, you don't have 4 or 5 guys saying this in a 60-day period without this kind of being orchestrated, in my opinion, watching the Fed for as long as I have. So in that sense, the dollar breaking out would be a risk to the credibility of their inflation target. Given that inflation is kind of falling, it's not an issue, it's not near target, it's moving away from target, and the Fed keeps downgrading their forward expectations for inflation. So to me, this kind of puts the Fed in play. But again, it's not about an economic thing. So everyone's looking, hey, the payrolls are pretty strong. Wage growth is, still 2.8% year over year, which frankly is not high enough. That the Fed doesn't need to cut rates. On the other hand, when you look at the globe, and you look, even we haven't mentioned Turkey again, the central bank governor was fired there. I mean, it's another case where, it's a hit to the credibility of all central banks, of all debt, of all paper. And that comes back to being the biggest case for gold anywhere. And I think, frankly, that's a big reason you've seen Bitcoin rally so much. And we talked about that, 2-3 months ago, saying, and I've never been like kind of a bull on Bitcoin in any stretch of the imagination. And we actually got bullish on Bitcoin because there was going to be flow as you see this general kind of slow but very noticeable rise in distrust and concern around paper of all kinds, because currencies, bonds, it's all debt. And at this point in time, they're going to create more, and they're going to start paying consumers in Europe to actually, borrow more money. I mean, that's really bullish for the precious metals in particular.
Yeah, Greg, you're one of the floor guys we have on the show, and I know you've given us some good floor stories over the years. And I don't know if you've given us all of them, but you've told us some fascinating ones in the past. Is there any new one? I know you were one of the taller clerks there in the gold pit. Anything you'd like to share with our listeners?
Well, I don't know. I mean, your listeners don't have to potentially deal with, fist fights while trading, and trying to keep the book while people are, in madness and mayhem around you. The only thing I would say in terms of that is it kind of does the differential between old school, okay, and literally when I first started on the floor, everything was written down. You're talking about pen and paper. It's almost like horse and buggy type stuff compared to what you have going on now. And not only that, but you had outs, and you had big disputes over, hey, you were waving at me like this, that means sell, and the other guy's like, no, I was trying to buy. And you would have fist fights on the floor below the trading floor. Trading floor was on the 7th floor. 6th floor was called the write-up room. And you would go down there, and you're talking about 6-figure, what they called outs, quote unquote. You have an out. This guy knows buy, I know sell. We have 6 figures worth of outs. The market has moved $20 in gold in the meantime, and you had some big confrontations. And let me tell you, you're talking about New York City. You're talking about kind of it was really macho, machismo, almost like playing kind of professional poker at a real high level, where it's my bluff against your bluff. I know that you know that I know that you know, type of thing. If you remember the Honeymooners, right? But these were big, rough and tumble guys from the they weren't it wasn't so much like PhDs from college in the pits, man. These were like real street type smart guys. So I just looking at the differential now versus where everything's technology, everything is kind of brainiac, and that's a great thing. But at the same time, to me, this, extends the potential for some kind of meltdown scenarios that we've seen, where now these are really more, things that could really happen more easily. And I continue to look at the high-flying tech stocks in the U.S. as being susceptible to this. You got such high prices. The volume, the actual turnover of shares has dried up because the prices are so high for a single share. And everyone owns them, man. These things are saturated to the max. Passive investments, ETFs, the whole 9 yards. Everyone owns these same stocks. And if you could hit a buyer's vacuum, this is the kind of situation where like guys on the floor and specialists and locals and all this kind of stuff, would intervene, even the same vein as the New York Stock Exchange. That kind of dynamic is gone, and some of those safety checks aren't there anymore. This, really the speed bumps for some of the moves. And in this case, to me, some of the high flying tech shares still very vulnerable to any kind of, you get a broader move for liquidation. If the Fed makes a misstep, if you get some kind of, more geopolitical situation developing into a problem, you really have to be careful and nimble. I just want
to make one comment. The DAC, what he's referring to is like the orders, the clerks or traders will hold. And on the upside, you have all your limit sells and all your buy stops. And on the downside, you have your limit buys and your sell stops. And just being on the floor, I remember being in the S&P pit, the book would build up on one side and it would keep building and building and building. And like in a rally now, I bet you almost all the paper's been taken out on the upside, right?
Yeah, absolutely.
So now you've got a big old book here to the downside, and people waiting to get in, or people using sell stops, and it's just amazing what you're talking about here. And there's a big old book to the downside. We'll see if we can get some downside action to clear it up. But thanks a lot, Greg. We love your fundamental takes on the market.
My problem. My pleasure. Anytime, guys.
All right, Greg Weldon has been on with us. Weldon Financial. Thanks a lot, Greg. 8:51 here. Dennis, before I forget, I have a new pair trade for you today.
Give it to me.
This is the space travel pair trade. You can go long Elon Musk and also go long Virgin Galactic. Richard Branson startup there emerging this morning with social capital. Hedosophia IPOA is the ticker on that. The merger is supposed to be
social capital is buying Richard Branson.
It's a merger. And so they're going. So social capital will own the majority of Virgin Galactic, and IPOA is the ticker. You can go long space travel. You can go long.
That's his main business. Is like sending people to space. That's what he's trying to do. Is that like the main gig there?
Yep. And they're saying that to space tourism will begin within a year. They're saying.
You think Elon Musk, SpaceX has got to be going to do this too now?
Yeah. Oh, yeah.
Sure. They're going to do this too?
Sure.
Would you do that? Would you do it, Joel? Would you hop in a rocket ship and go up and see what the Earth looks like from, I don't know, whatever it is, 100 miles up or whatever?
Absolutely not.
You don't like the risk return on that?
No. Nope. I mean, flying's okay, back and forth or wherever, but not getting me on any spaceship here. Not getting on there.
Well, maybe if I was on my deathbed.
Well, these space.
Yeah, you're probably not going to get me up there either. Risk manager here, rocket ships. It'd look pretty cool from up there, but I'll just watch it on TV.
Well, the space tourism pair trade is on IPOA and Tesla. Those are your space tourism trades to make.
S&P is still down 11, kind of quiet here during our hour pre-market session here. More ratings here. The analysts are kind of mixing things up. Initiations.
I do want to talk about Netflix. It's not a rating per se, but it is positive commentary from Cowen. Let me pull it up here. They expect, let me just find it in my doc. I had it. There we go. They expect that Netflix's original programming hours in the second quarter to have risen more than 52%. And they expect the high viewership for season 3 of Stranger Things will drive gross additions at the end of the second quarter into the third quarter. Not an upgrade, but positive commentary on the topic of Stranger Things 3. Netflix announced yesterday, and this comes with a couple caveats here, but they said 40.7 million member accounts have watched at least a part of Stranger Things so far. So we know Netflix does not release a ton of data, so we don't have anything to compare this to really. 40.7 million member accounts. That's not subscribers. That's accounts within a subscription. 1. 2, Netflix counts a watch as having watched 70% of one episode. So that qualifies.
What show?
This is for Stranger Things 3, which I also watched over the.
Do you watch that, Dennis?
No.
But the point is.
No, I watch like Wheels on the Bus and.
My point is.
Paw Patrol. Paw Patrol's on my Netflix nonstop. The 2 and the 4-year-old.
My point is, according to Netflix, Stranger Things 3 set a viewership record over the first week that it's been out, or whatever. It's 5 days since it was released. 18.2 million member households have finished the show already. So the point is, Netflix coming out saying a ton of people watch this show. Cowen came out and said, thanks to the show, we expect more subscriber ads around the end of Q2, early Q3. So positive commentary this morning. The stock's last I checked was up $4.
Yeah, up for 324, 379.40. I'm just looking at this from go to a monthly chart here, and you could just draw a line here. Let's just call it 385. Yeah, I mean 85.99 I see is a monthly high, 84.80 is a monthly high. This is going back over, till October of 2018. So to me, kind of coming up at the top of the trading range here. I'd look at 380 to 385 as a sell zone. I know it has earnings coming up. I don't know. I'm thinking of canceling my Netflix. I don't know when the last time I even watched something. I don't even know the last time.
Mine's on nonstop with the kids. There's
no
commercials. I mean, I watch. Okay, so here's you watch your cable TV, and Paw Patrol, which is what the 4-year-old addicted to. It obviously on the cable TV on Nickelodeon, and the commercial length is absolutely ridiculous. So, and you can tell it feels like an hour because the kid's complaining about the commercial, right? So it's on live TV and they watch for 8-9 minutes and then they have 5 minutes of commercials. So the kid's now lost complete interest and is now running around destroying my house. So I put the Netflix on and it doesn't have any commercials on the Paw Patrol episodes and I don't have any of those issues. So I'm like, man, it's ridiculous. Like when were commercials, the commercials used to be like 2 minutes. It's 5-6 minutes of commercials straight. Give me a break.
I don't know
that many commercials.
I don't know if they're ever that short, but it feels that way, doesn't it? Because anytime I'm forced to watch something on, I get like 5 channels, right? Yeah. So I get like, NBC, CBS, Fox, ABC, and like PBS. And anytime I'm forced to watch it, like Sunday when I was watching the World Cup, there was no commercials during the game, but before and after the game there are. And man, does it drag. Holy moly.
Oh, it's forever. I mean, like, why do they have to be that long? They're literally on between that Paw Patrol and Nickelodeon. It's 5 minutes of commercials. I was like, there was like 20 commercials. Give me a break. Like, okay, maybe it's only got one round of commercials. They just stick it right in the middle of it all, but it's too much. I mean, when you can go on Netflix and not have any commercials at all, it's so much better. So you know what? And my commentary here is, as people continue to cut the cord, this is a stock that has valuation has always been an issue here, but this looks like a cup and handle to me. From if you go out to the monthlies and you look at the 2018 collapse down to like 250, and now you're just hitting here between 340 and 380 for the better part of like 7 months. It starts to go to 385, you're going to challenge those all-time highs, in my opinion, then over 420. So I think Netflix is working its way to break out. And I'm not sticking this in the investment portfolio, but the swing portfolio, I'm interested in it here. Yes, you're up at resistance, so it's hard to buy a stock at resistance. Joel's a very good point. Why buy a stock until it's actually breaking out? But if you're playing classic breakouts here, this looks like it's gearing up to go to me.
All right. Any other ratings here that we should cover?
Yeah, there are. 3M catching a downgrade this morning from RBC. I guess you could say that's a little late to the party, but thank you very much for that.
You'll find buyers. You'll find buyers in this.
Yep. 3M was a notable one. What else am I seeing here?
I don't know where you find buyers in 3M. That is an ugly chart. That trend is down. I mean, this was bad news again yesterday with that analyst commentary. They talked about it on CNBC. I can't remember what it was because of the goldfish memory, but this 3M chart is still in a serious downtrend here. I think eventually you could try that 160 again. I think if you come at 166, I think you're early. The stock is out of favor. I
just think that you put in that rounding bottom, in
helped.
June, you came off it. And, if, probably pretty heavy short interest in this thing after the last report, you watched it go in your face from 159.63 to 175 and change. So 16-point move. I don't know. I just think, 160, where were we at? 166.88. I don't know. I just think, I don't know when the next report is here, but you did have a whole string of buyers in this area, in June before it bottomed and then June afterwards. So I don't know. Could sit here for a while. I just don't see it whoosh.
It's better places for your money. Just so we're on the opposite end of the coin on this one.
Yep. Okay.
I don't like buying stocks in downtrends. It's heavy downtrend.
Square caught an upgrade this morning to neutral from Raymond James. What else did I have?
Gearing up to go. I mean, I'm long Square. I bought it. This is one I bought perfectly. Like we said before, I bought it down on the last day of May at like $62, and I'm holding on to it. I think eventually Square is $100. It's my long-term portfolio. I'm sticking with it.
74.50. Just look at that whole area. I see last three highs right there. Let's call it 74 even at 74.36. Another high at 26 and 55. So above 74 and a half. Nice breakout here. 60 cents away. After that, I'd say you get a nice pop back up. Where's your next area? Maybe you see if you get through that area clean, maybe a little stronger market. My next target would be 76 and a half.
All right. Just not much else from ratings lane. JP Morgan downgrading Marriott and Hilton this morning to neutral. But that's going to be it, I guess, for today's show. Oh, today's also the end of the analyst quiet period on Chewy.
Let's talk Chewy.
You're getting a bunch of initiations this morning on Chewy, which I actually have not looked at since I sold it. But what's they been doing?
Hanging out, really doing not much of anything, Spencer. Here's a lot of analyst bullish commentary here. All the underwriters coming up bullish, which is expected. Stock shrugging it off and still going down here today, so they weren't bullish enough. Anyway, stock's at 34. I don't know. It's not up on a lot of good and positive commentary, so I don't know what brings it up.
So let's see. You got 1, 2, 3, 4, 5, 6, 7, 8, 9, 11 initiations today, and 1, 2, 3, 4, 5, 6 of them are neutral. So you're and you know an underwriter is not going to initiate at sell. So neutral is like the worst you're going to do. So about half outperform, half neutral this morning.
Well, about as bullish as you're going to see.
Well,
the stock's down 1% on it.
Yeah. Anyway,
I mean, there's no crazy price targets on there either, though. What were the price targets? They're like 40, 38.
Let's see what is the highest? The highest is 42.
Yeah.
Yeah. So nothing, and the lowest is 35. So
what? This sells pet.
33.
This sells pet food online, does it not?
Yes.
Why is this not pets.com part 2?
They've got like a culty fan base. Everyone ask. I know you don't have a dog. Ask a friend of yours who ask Joel. You have a dog.
I have no interest in this. I have a cat.
Ask Lisa about Chewy. She knows.
She knows. She gets all the dog food through Amazon.
Okay. Well, ask your friends who have pets about Chewy. They love it. It's.
Some people love it. This feels like pets.com part 2. Go back to 2000. Google pets.com, and the stock traded with crazy valuation and eventually went to 0. I'm not saying it's going to 0, but I'm not paying any crazy multiple for an online pet food store.
A lot of dog talk today. Paw Patrol. I finally figured out what you were.
Chewy.
You were I don't know what you were saying on that, but
dogs are barking.
Yeah. All right. Well, we'll see, folks.
You don't know what Paw Patrol is?
How would he?
Joel, you've never heard of Paw Patrol.
Why would he know that?
Paw Patrol. Paw Patrol.
Yeah, it's a kid show. I only know it because it's like very.
It's
popular.
like police dogs, basically, or I don't know.
Oh, I didn't even know what that. I just knew it's a show. I don't know anything about it.
I just found out about the shark thing. Like
Baby Shark.
All right.
Joe's always a year and a half behind on this kid stuff.
You know what? This show is
Baby Shark. Do.
All right. This show is Jump the Shark. We're getting out of here.
Cut this off fast. We're losing listeners quickly here.
We're losing everyone. All right.
Baby Shark. Do. You gotta do
final thoughts.
Baby Shark.
Final thoughts are
Daddy Shark. Do.
Okay. Forget the final thoughts. We're done. Thanks for
cut it off.
Thanks to all of you.
Don't do it. He knows it. He knows it.
Please remember all the information from our show is meant for informational purposes, not meant to be investing or trading advice. Have a good rest of your day, folks. We'll be back with you hopefully.
End it quick.
Yeah.
Grandpa Shark's coming.
Yeah, we'll see you on Wednesday. No sharks on Wednesday.